Welcome back to another week, everyone. Glad to be here. And one of the highlights, I think, of our year every year is hear from our legislative economist, Tom Cavett, about the consensus revenue forecast. This is Tom's, I think, maybe eighth time giving this presentation, but we are one of the first legislative committees to receive the presentation, so thank you for that. I think it'd be great if we all went around and introduced ourselves before we start, because I think there's some new folks on the committee, and we all have printed copies of the revenue forecast in front of us. But if the graphs are something you want to zoom in on, you're welcome to open them up on your computer so you can play with them a little bit more. So I'm Emily Kornheiser. Hi.
Bill Canfield.
Julia Andrews.
Catherine Sims.
Jim. Scott Beck.
Chris Mattos.
Kirk Taylor.
Peter Anthony Barry.
Carolyn Brannigan from Georgia.
Carol Odie, Burlington.
Carl Demerol.
And then I think if you want to go through most of your presentation, and then we can hold most of our questions until the end so that you have a chance to.
Yeah, I mean, I think these sessions are best used for Q&A. So I'm going to be fairly succinct with the overview, and then depending on the questions, we can dig deeper into lots of different aspects of it. There's always a great deal going on in the economy, and we look at thousands of pieces of data, and assembling this. And so there are lots of things that you may have questions about that we could talk about that aren't even in the report that are happening in the state. They're basically, and this doesn't differ from the legislative presentation just a month ago and the July presentation and going back to January, there are two really seismic macroeconomic forces kind of butting up against each other. One is foot on the gas, full pedal to the metal, enormous amounts of spending, federal spending and federal stimulus that is just nothing that we've ever experienced before. We talk about what $10 billion is to the state and, this sort of thing. It lands in a plethora of places when this much money flows in. But that's like 30% of the Vermont economy in a year. The total GDP for the state pre-pandemic was less than $30 billion. And we got 10 billion just in the pandemic stuff. And then there's been infrastructure money on top of that. And much of this money was deficit spending, so it's highly stimulative effects. And more than the economy could digest, which is what's giving rise to a lot of the inflation that's occurred. And it though is driving receipts in a lot of different tax categories, because as that money flows through the economy, it's taxable in different ways. There's a chart kind of far back in the presentation, but just to give you an idea, this is on like page 22, maybe? Yeah, page 22. It's a chart that shows the depository base for the bank franchise tax. Bank franchise tax is a backward-looking tax. It's a teeny percentage on bank deposits for the last 12 months. So the last 12-month average, every bank sees how much the deposits have been, and then they pay this.
What page did you say?
32, sorry. I'm a little dyslexic. I think I said 23, but it's 32. Yeah, 32, sorry. I don't know what's on 23. We could talk about that.
No chart.
No charts, okay. Maybe a cartoon or something. But this is the sort of thing we've seen in lots of categories. This is one of the more boring tax revenue sources. It's really flat. Doesn't usually provide a lot of growth because, bank deposits are fairly, steady kind of thing. This, by the way, is not directly linked to revenues because there are a whole bunch of credits that banks end up taking out before they pay the bank franchise tax. So affordable housing credits and various things like that. And those are not small, so of say, it's usually 12, 13, $14 million a year, 3 or 4 of that's just taken out in credits. It would be $3 or $4 million higher before that. But this is ignoring the credits. If you reverse engineer the tax rate, this tells you what the depository base would be. And you can see it's like pretty flat for quite a while. And then all of a sudden, sort of 2001-ish, late to 2020, 2001, it goes up like 47%. So it goes up by $6 billion. And, that's not all the money that's washing over, because many people and lots of companies don't hold liquid assets in depository accounts. There are lots of other options for that. So this is just like what's in the banks. But the fact that it's Vermont specific, we see this across the board with lots of other assets and lots of other metrics at the national level. So, but when that occurs, what that's saying is there's just that much more money around. The money's getting spent in lots of different ways, and depending on how it's spent, we get tax revenue from it. And if the tax revenues, like the tax is based on a percentage of expenditure, like sales and use or meals and rooms or motor vehicle purchase and use, then, as those flows increase, we get a lot more money. But anyway, that huge tranche of money has been highly stimulative and is, pushed the economy to the limit of what it can produce and then some. And the and then some is captured in inflation, because that's essentially a way to make supply and demand equal by making the dollars less valuable. And that is, like, if there's one takeaway from this forecast that you should take is, yeah, there's a lot more money that's coming in, but it's worth a lot less than it used to be.
Right.
So in the e-board thing this morning, I said there are pre-pandemic dollars and post-pandemic dollars. And the money we're talking about today is post-pandemic, even though it's not altogether over, but, they are worth at least 15% less than a pre-pandemic dollar. And in some cases, depending on what you're buying, 30, 40, 50% less. So when you're looking at the expenditure side of everything that's done, you can expect to provide the same public services. It's going to cost a lot more in the coming years. And if you're thinking, we have a whole bunch of extra money, yeah, some of it is truly extra and it's free, sort of in the sense, that it doesn't come directly from Vermont taxpayers with a federal largesse, but it's going to buy a lot less than it used to. And as we speak, it keeps buying less and less and less. So anyway, yes, Carol.
Are we in time for questions yet?
Yeah, any time for questions.
So what does this do to our debt? And did we even have any debt?
At the federal level, it's huge debt. At the state level, nothing.
Okay, so at the federal level, does this get rid of a lot of our debt?
No. It adds to the debt because it's not financed with tax increases or spending cuts. It's deficit spending. Not all of it, but lots of it.
If the money's worth less, then the debt is worth less.
Oh, yeah. Well, it will affect debt as well as other things, but the nominal value of the debt goes up. And the cost of that is a function of the interest rate that, how much has to be paid to incur that debt. So our interest expense at the federal level will go up substantially. I think CBO projects it to be almost as big as the defense budget at some point.
Oh, my.
Yeah. So that's the cost. And the other thing that's happening, so that's one side of things. That foot on the gas, economy's going great, demand for jobs, demand for stuff, across the board is just, skyrocketing. On the other side, the inflation that's been produced in part by this, and that's not the whole story of inflation because supply chain problems are a big part of it too. Because there are many countries in the world that have not had that kind of spending and they're still experiencing a lot of inflation because supply chain issues that there are lots of different things, like the single largest increase in the CPI for any single item pre-pandemic to now is eggs. All right. And you say, well, why eggs? Well, it's another pandemic. It's an avian flu pandemic and it's wiped out laying hens. And so eggs are scarce. And so the price goes up. There's nothing the Federal Reserve can do that affects that, no policy move on that that's going to, increase the supply of laying hens or, whatever. You could raise the price high enough that at some point, demand equals supply. I mean, you're seeing the market do that. It's pushing the price way up. They're like 75% higher than it was pre-pandemic. But essentially that the Fed's response to the inflation is put on the brakes, raise interest rates. That's their main way to put on the brakes. They also pull money out through quantitative tightening. And so they do what they can, but interest rate increases are the primary mechanism that they use to slow the economy down. The idea being there's less demand, then whatever supply is there is going to be closer in balance to the demand. But it's not an even thing. If in theory, the government would do a lot of different things to slow demand down. They could just raise taxes. That would just pull money right out of people's pockets right away and would reduce demand. But politically, that's really hard to do. So they could also just ask everybody, would you please spend 10% less next year? And if everybody did that, you wouldn't need to raise interest rates and you wouldn't need to raise taxes. It would just but everybody'd have to do that. That's never been tried either. But anyway, the way it's typically done is if you don't do anything, inflation will ultimately go up high enough that supply and demand will match. The problem is that it will get baked in after a while so that expectations are for it to continue. And then it sort of is a self-fulfilling kind of thing that can be really problematic to the economy. So the Fed really wants, more than anything, they want to tamp down expectations. And that's why their talk is so harsh and tough. They want everybody to think like they're going to do whatever it takes, even if it's a recession, whatever. I'm not saying that that's idle chat, but that is in part psychological because they don't want people to think that they really expect it's going to be 5% next year and not 3% going to 2%, And so anyway, when you slow the economy through interest rates, you're increasing the cost of borrowing, cost of credit, and that impacts different people and different sectors of the economy in different ways. And there are always winners and losers in these sorts of things. And it's who has what relative power. So if you're a company and you can pass prices along, you're fine with an inflationary environment because you can pass them on and often round up a little bit and even have wider profit margins because everybody expects prices to go up, so you don't have the same sticker shock at some point and, people kind of expect it. If you're a unionized employee and labor markets are as tight as they are now, you can get very substantial wage adjustments and wage increases, and you'll end up being a winner in an environment that's like this. But there are also lots and lots of losers. But anyway, sectorally, it's going to affect things that rely on interest. So housing is one, single-family housing particularly. New car purchases, 85% of them are financed, and used car purchases, about half of those are financed. So things like that will be getting a lot more expensive and people buy less of them and do less of that. But it also stunts a lot of investment and growth in new companies and startups and things like that, because you need capital often to do something to get a new idea going. So the big foot on the brake, big foot on the gas. And when we put this in, we plug this into model, we've never had this much on the gas ever. So there's no historical precedent. All the models that we use are based on historical data. Lots and lots of historical data, but there's nothing in there that says, well, what happens? And so most of the models show that the brake works pretty quickly, like 6 months, 9 months, you're really starting to see results. Well, we're like almost a year down the road and we're not seeing much in the way of results. Inflation's come down some, but it's mostly because the energy price spike from the Russian invasion of Ukraine dissipated in a way that was very favorable and lucky in part with warm weather in Europe, but also just there was a lot of adjustment by private markets that muted that impact. And it actually ends up affecting the transportation fund. I'll talk about that if anybody's interested, but the gas taxes were heavily affected by that. The thing that's most different is, what shows up in savings, in money that's sitting on the sidelines that can be used to, kind of keep buying even when prices go up, even when interest rates go up, to like keep that demand coming. And that demand has still been coming. So that's why year to date, we're seeing revenues way above, what we would have expected. And we think that momentum will carry through, not in full measure, but in large part in the second half of the fiscal year. But in fiscal 24, there will be a much more substantial decline. If we just look at the available general fund, again, these are from high levels, but the available general fund, which is, the numbers you use for general fund money. We have this source table so that all the allocations, don't distract from it. But if you just look at available general fund, excluding the healthcare part, because that wasn't done historically. That part of it was outside of it. But all the major taxes that the state relies on, it's expected to decline 8.9% in fiscal 24, and that's the largest decline in 25 years that would ever have happened. Again, it's from a high level.
And it's not declining below where we were before the boom.
And that's the other thing is so it's gone up dramatically. Even since July, with that decline, there's almost $40 million more than was expected in July. But still, it's still a notable decline. And that's with an assumption that we don't have a full-on recession. So that's a forecast that has sort of what's called a soft landing. And whether, the soft landing really happens or not, who knows?
Representative Odie, did you have?
Anyway, that was my
Okay,
question.
Representative Beck.
So, thank you. I listened to some of the work over in. So what I'm trying to figure out is this blip, that increased income tax revenues that we've experienced. I'm kind of waiting to see whether that is a bubble or it's a rebasing of the economy or some combination of the two. And from what I'm getting today is that since July, that we now think it's a little bit more of a bubble than we thought it was in July. Is that?
Actually, it's both. I mean,
Yeah.
But there is a rebasing because that money doesn't disappear. Like the money that's in the banks, somebody spends it, unless they send it overseas or out of the state,
Yeah.
then somebody else in the state gets that money and either puts it back in the bank or, pays taxes, it circulates. So there are going to be more dollars around everything. They're going to be worth less because we don't have the people or the capacity nor does China or any other place in the world that we're getting stuff from to fulfill all the demand that would be associated with that. So, so both of those things are happening. There will be revaluations of assets because a lot of assets go up in value based on leverage. And when interest rates rise, that leverage gets kneecapped. And so you can have a steep decline in asset prices, and then a lot of the taxes are based on that. So capital gains and things like that are based on an asset price change. So there are going to be some categories that will drop very sharply, like corporate and personal income. They're much more vulnerable to decline. And I've talked about this before, but they're sort of backwards looking taxes. You know, you're paying estimated taxes on, you know, based on what you earned the prior year, if you're an estimated payer, and, you know, paid returns are going to be based when you do the actual filing, but it's a truing up of the difference between, you know, what you thought you would owe and what you actually owe. And so when it's increasing rapidly, we get a lot of payments and low refunds. If it flattens or declines, you get the opposite. So your current liabilities are lower, but then you've already paid ahead on a lot of stuff and you get a refund. So that really, you know, can turn on a dime and drop quickly.
So Tom, the price of the eggs I buy hasn't changed. And I was buying expensive eggs before. They're like local organic Brattleboro eggs, as I'm sure everyone would assume I'd be buying. But the price hasn't changed through like all of these massive articles about the egg shortage, and the eggs are still there. And so, you know, thinking about sort of our more resilient pieces of our economy, and people talk about that being localized. But then at eBoard, we were talking about how our corporate revenues have become incredibly diversified because of previous legislative work that we did, and how that creates some slightly greater degree of stability, but still very unstable. And so I'm curious to hear from you, as, you know, last year's revenue projection was sort of more unstable, you know, because we're living in these historic times. But do you have a sense of a shift in our understanding of what more stable or more resilient revenue sources might be going into this next phase?
Well, some just by their nature are more stable than others,
Yeah.
you know, so the most stable are often have the lowest growth potential. So
Yeah.
you do something that's a fee, you know, that's based on something that people have to do.
It goes up with inflation.
It wouldn't go up, the fee wouldn't be
Yeah.
fixed. And so unless you get a numerical change, you know, then it just stays flat, but that's very stable, but it's not giving you any growth. And if it's funding something that requires growth, then you're in trouble. But something like a sales and use tax is just much steadier kind of thing. If it drops, it might drop by 2, 3, 4, worst case 5 or 6%. But you could have a 20% drop in corporate revenues. Like, you know, there's probably been 4 or 5 of them in the last 30 years.
And I think I'm thinking less about tax types and more about areas of the economy and sectors of the economy.
Yeah, so, well, some sectors are just a lot more cyclically sensitive. Housing, because of its connection to interest rates, tends to swing up and down much more. Also, the way demand gets satisfied with residential and non-residential investment it takes a long time. You'll recognize more demand. People need more houses, but then you have to get land, then you have to get permits, and then you have to actually build something and finish it. So even the building can take a year or 9 months if it's fast. And so you can have 2 or 3 years by the time there's a signal that, yeah, there's a need for this, and then there's product. That lag means that, you know, the price is going up that whole time. So prices really get high. And then you have too much stuff being built and you can't just stop it. If a house is halfway finished and you're a speculative builder, you're not going to stop, then you've already got money and then it's not worth anything. So you finish it, but it swings high and low because of those lags and imperfect market information. In the case of your eggs, if the price hasn't changed, it means that the sellers probably could be shipping to another market that might be affected by this bird flu and get more, and are choosing not to, or have a long-term contract with the seller, the retailer that you're working with. But if they had been affected by the pandemic or are in the future, pretty much the only thing you can do is call the laying hens, and so you would end up, you would see a price at some point thing. It just depends.
I was
how
using
widespread
fake
it is.
chickens as an illustrative example of sort of.
Yeah, but it's a good one because that's how we experience inflation, and it's different for everybody, And gas prices are sort of right up there with the big signs you drive past. Like when prices are going up or down, because it's like out there. It affects consumer sentiment so strongly because everybody sees it. But some things you don't. But everybody in this room has a different CPI profile based on the things that you buy and your willingness to substitute or do without and things like that. And all that affects prices. Yeah.
Representative Anthony?
Yes, thank you, Madam Chair. My question is to broaden a bit both your interest in a reset in the meaning of stability or reliability and Representative Beck's interest in whether or not we're really rebasing or bubbling, as it were. And the broader question for me is when would you know and therefore convey to us if there's a reset, for instance, in the very broad decision to spend money as opposed to banking, savings ratio? Because obviously that resets a whole myriad and the baseline becomes reset. And so that for me is a really important piece of information.
Yeah. I think the hard thing too about savings, when you talk about, funds that are meant to provide a continuation of services through a downturn in revenue, is you really, really have to understand how much more money is going to be needed because it buys less. And I don't think that goes into the planning right now. The amount of analysis that gets done on expenditures versus revenues is way out of kilter. In a private company, it's not. You're really looking at the expenditure side just as hard as the income side and trying to, work with both. But I don't know what a projection would be because you'd want at least a 5-year kind of window. And if you're anticipating, you'd have an inflation assumption to that, you might need a much bigger current reserve to do that.
If I may, a follow-up, that's what your reliability factor is almost always temporally sensitive. You can be spot on in the moment, but I'm asking over the curvature of the earth kind of question.
Yeah, but that
and I mean we gotta worry about that.
Yeah,
because there are political pressures to, if you got it, spend it or do something with it.
Yeah,
and that's not where I am.
Yeah, well, that is why we have started doing 5-year projections. There's no enterprise the size of state government that doesn't do projections that are at least 5 years and often 10 years out. Not that you're getting perfection of foresight, but you're understanding how to balance risk. And you can run an alternative scenarios and say, what if we're wrong by X amount? And then where would it be? And you true it up all the time.
Yeah.
You get new information, you true it up. And then you can see what that difference is and you can take action. But almost everything's done on like a 2-year sort of thing. It doesn't really often think farther ahead. And I think that would improve decision making. And I think it's especially.
But our election cycle's only 2 years.
Well, that's a problem.
Constitutional amendment.
But there are some of you who've been here a lot more than 2 years, so,
Yeah.
yeah. So anyway, hopefully there's enough continuity that good decision-making's made. Yeah.
Thank you, Madam Chair. Tom, I'm just looking at your page 1 there and thinking about what you've said about how the dollars that we have are going to be buying us somewhere between 15 and up to 50% less at pre-pandemic levels. And then looking at the revenue figures and thinking about how much less revenue there's going to be, or you're projecting in FY24. What, for someone who hasn't been here for more than 2 years on this committee, what should I be thinking about if you were in my seat? And I know that's a different, that's apples and oranges, but what would you tell me that I should be thinking about for the next rest of this session as we go about our work?
Well,
If there were 2 takeaways, aside from there's the money is worth much less than it was pre-pandemic, and that we are going to see a big reduction in revenues as we move along here.
yeah, so that impacts this, the notion we were talking about before about whether you save or spend. You really don't want to be committing long-term, based on this. So whether you call it a bubble, I mean, there is a bubble aspect to it because it's a big infusion, but there is also just an increase in the base that will be whittled away by inflation, is being whittled away and has been. And so both of those things argue for being pretty restrained with longer term commitments. So using money to, address things that are more like one-time type things, be treating the money more like one-time sort of money. I mean, they're sort of true one-time events that sometimes we pull out of the forecast and all that, but cyclically, this is really unusual. And I think there's enough uncertainty about it that I would be approaching it in that way.
If we were using that unexpected revenue to invest in things that would generate more revenue down the line,
Always a good idea.
I think so.
Yeah.
What sort of, given the way we imagine the economy is going to look over the next 5 years, what might be places you might see that useful?
Well, I don't know that I would have to study what your options are, because there are always sort of politically possible options, and then, other kinds of things, like you could say let's dispense with this interest rate increase and just ask everybody to spend less, I mean, yeah, right. But is that going to, would you pass a law saying that's what we're going to do? Probably not. Yeah, so I think you'd have to be more specific about the options that you might have, and I'd be happy to comment on, things that seem like that. Also, there's a lot, oftentimes everything's sold as being, we're going to get back more money than we've put in.
Yes.
It's not always, the case. So that's good to sort of fact check that to some extent. And sometimes you don't know, and that's fair, and that's important to say too. Other questions, or I can go into some other stuff that's just, I don't know how much time we have.
We have a little bit of time, so
Good.
we want to actually
Yeah.
go through the presentation.
So there's,
Great.
well, I'll just jump around a little bit.
Great.
There was a category of income that was really surprising, was interest income, which is normally, $2, $3, $4 million a year, and there's a little bit in the ed fund, mostly general fund. All of a sudden, through 6 months, we have $10 million in interest, right? So combination of a higher balance, much higher interest rates, and the treasurer's office felt like there was enough of a balance that they could do things like buy 6-month CDs, because they wouldn't need all of that money and get a much higher return on the money that's just sort of sitting there, or even if it's going to be used at some point. But that resulted, in maybe $15 million more in this fiscal year than we had anticipated. That's so if the treasurer needed to, somebody to focus on that, that would be a very good return on investment in terms of, let's maximize the money that we're getting from whatever cash balances we have. The transportation fund I mentioned had some anomalies, with the pricing changes. So there was a fairly, you had this, price decline that affects the motor fuel assessment tax, which has a complicated price linkage. So prices have to be pretty high for that to really kick in a big way. But it got there for about 2 quarters or so. And it was expected to stay there for a little bit longer. But the drop in prices took all the wind out of that sail. On the other hand, the per gallon tax is just based on volume of gallons. And that really dropped during the pandemic. People just weren't driving. And we sort of expected that to come back. And it just didn't come back as much as we had expected. This is like gas gallonage, and it's not anywhere in there, but you can see this starts in 1986 through, December. And this is, we seasonally adjust all the data. And then the dark line is what's called a trend cycle. So it's a statistic that comes out when we run seasonal adjustment programs. And so, but you can see how like gas gallonage peaked like sort of 2003 or 4 and has declined since then. And then really dropped in the pandemic, but it just didn't come back that much. So people are still not driving as much. They're working remote more, and then switching slowly to EVs and, but the stats with the electric vehicles, eventually they're really going to make a difference, but they're still pretty small in the whole, scheme of things, but more efficient gas vehicles too. So just less gallonage, less travel. So the combination of the price dropping and not really a return to the gallonage has meant that the gas tax is quite a bit lower. Motor vehicle purchase and use, though, has been completely hamstrung by inventory, limited inventory. And there is a chart on that in here somewhere.
Um,
33.
If you don't mind me asking, one of the things that I was thinking about is it does appear like Vermonters have more money in the bank right now, but I'm wondering how that will be affected by shortages. Are people planning purchases they've not yet made, and therefore there's really not the savings that we see?
Yeah, so that's one form of savings and assets. Let me go to a bigger one, which is like all assets, what your net worth is. And this isn't Vermont specific, but there are a couple of charts and there's a table. The first part of this. Okay, so the chart on page 12, the table on page 11. So the chart on page 12 is total net worth. So this is all assets, the value of stocks, bonds, real estate, cash in banks, personal property, minus liabilities. And the Federal Reserve breaks this data out so this is total net worth. So you can see this big increase in net worth. Looks just like the bank thing, it's sort of same kind of all of a sudden jump. And then if you look at the numbers in the table on the preceding page, it's page 11, it breaks it out by household net worth. There are a bunch of different breakouts, but you can see like top to bottom, so the bottom 50% of the population, these are percentile groups that, are substantial enough to have at least a single digit number as a share. But in order to get that for the lowest one, it has to be 50% of the population. So they only have about 3% of all net worth. But anyway, if you look at pre-pandemic, the average household net worth of the bottom 50% was $33,000. And a lot of that's in real estate. So, and personal property. So a vehicle or two and some equity in a house. That's generally what you get. And lots of liabilities, credit card debt, other things like that too. But that went from 33,000 to 70,000. It more than doubled. That's a big increase, even though, again, it's a fairly small number. The next 40% went from 625,000 to 750,000. And the next 9% from 3.7 million to 4.3 million. The next 0.9% from 17 million to 21 million. And again, the shares of net worth, owned dwarf the bottom 50, and then the top 10th of 1%, which they just started publishing, they used to include that as just, part of the top 1%. But the top 1/10 of 1% went from 104 million to 131 million. So that increased by 26 million. And the share of total net worth by the top 1/10 of 1% went from 12.1% to 12.5%. So all of that, though, says capacity across the board is pretty vast for, that's why, okay, their interest rate increases, everything else. There's still, a feeling like, I have more equity in my house. My bank account's still, I've got some savings, but it's dwindling pretty fast, especially at the low end, because we see this in credit card debt. We've seen it not quite back up to what it was before the pandemic, but getting close. And that was one of the first things people did, was pay down credit card debt, which is smart. It's the worst kind of debt you can possibly have. I mean, if we teach nothing else in our high school, economics class, it should be just do not use a credit card for financing purposes. Ease of pay, fine, but it is the most expensive, burdensome, way to deal with that. But anyway, those levels are rising, and savings rate, which is a chart on page 14, the savings rate, which went way up, in the pandemic, everybody gets a check. First thing they do is they don't spend it all. They put it in the bank for a while or invest it or do other things. Saving rate's down really low now. And that just means that's what's keeping consumer spending going. And that's 70+% of the economy. So, yeah.
Should we be more worried about the credit card debt because the interest rates are going up?
Yeah.
So
Yeah.
be a bit more worried about it?
Absolutely should be more worried about it, because you're going to get defaults that are much
Right.
bigger. Yeah. And a lot more pain, because, they'll try to just pay the minimum and then you
Get deeper.
just get deeper and deeper. And it's that is a problem. That's where an interest rate increase really bites. If you were buying a house in January, 30-year fixed rate mortgage, and, then figuring out what your total cost would be over the life of it, and then you bought the same house now, you'd be almost doubling price of things. So you can see why, that's it's a big deal for anything leveraged, anything where you have to borrow. Credit card debt, you kind of slide into it because you're thinking, oh, I've done this all the time. This is how I deal with it. Just a little, and then all of a sudden you get nailed with a big expense. Makes it that much harder to even, cover that. So, yeah, there'll be way more delinquencies and things like that. Other questions, or you want me to see if there's anything else that was interesting in this? Oh, one thing that was kind of interesting regionally, and we didn't do any of this for the governor, was looking at unemployment rates by county over the pandemic. So there's a chart on page 21 that shows unemployment rates by county before the pandemic, during the pandemic, and then now. And overall unemployment rates in the state are kind of the same map over and over and over again, where the Northeast Kingdom always has higher relative unemployment and almost any other economic metric.
And those are folks who are technically in the category of unemployed rather than
Yes.
out of the labor force.
Yes. Yeah. No, that's a different metric.
For jobs.
There are about 6 definitions of unemployment, and some include that, but the most common one is U3, which is you have to be in the labor force to be considered unemployed by that metric. But it's still, Orleans is 4%. That's the highest in the state. 4%'s, it's been 10.4 there at times. It's so not terrible, but still relative. It's always Chittenden is the best. Sometimes there's another county floating around somewhere, but Chittenden is always the lowest and Northeast Kingdom's highest. Unusual, Grand Isle is as high as it is. Sometimes in very small markets, the data are kind of erratic and not that reliable, but otherwise kind of the same picture we always see. But during the pandemic, Addison and Caledonia sort of are the only 2 counties that ended up with unemployment rates lower than their pre-pandemic rates now. So Caledonia was kind of a surprise, that it was that low, 2.8. It stands out in that map as not being part of the Northeast Kingdom, and sometimes it's in that same category. I don't mean geographically, I mean based on the economic data. Yeah. The highest increases, the highest rates were Lamoille and Essex. They both rose to 7.9%. So Lamoille, with a heavy leisure hospitality economy, was really affected. But both of them were lower than the highest ever rates they got. Let's see, though. Who set a new record? Yeah, Windham County set a new record high during the pandemic at 7.4%. The only county that set a record high during that period. Yeah, right. Not too far off some of the others, but it's interesting. The other 2 episodes where about half the counties hit their record highs was the Great Recession. And then the other big period was early 1990s, 90, 91, 92, deep recession in New England back then. So the counties that experienced the highest rate increases during the pandemic, Windham went 5 percentage points up from pre-pandemic, and Lamoille and Essex rose 4.9 and 4.8. So, and then Addison was least affected, only rose 2.6 percentage points, and Washington, where it rose 3 percentage points. Anyway, just interesting variation sometimes you get within the state.
And do you have a sense of I think about Lamoille and Windham County both being very tourism based and Washington County having a lot of stability because of government jobs. Are there other pieces that you would pull out of this?
Well, I mean, Addison has a pretty big ag component. So, but again, in terms of the total economy, that's not gigantic. But yeah, I don't really know all the causes. It was more just reflecting data that's there of interest. Yeah, often it's very predictable, but there are a few things that were anomalies, so.
I think,
Oops, sorry.
Go ahead.
Don't they have big aerospace in Addison County? Don't they have?
Yeah, so it could be a few big employers that might have, not been affected.
Yeah.
Yeah, that could happen. That could certainly
I
happen.
think there's like 2 bigger employers down for Jen's area.
Yeah,
Middlebrook.
yeah, the college is big. Yeah. Yeah,
Some of the reading that I've done about the economy nationally is that some of the people that dropped out of the workforce during COVID, particularly parents of young children and then older workers, did not come back.
that's true.
So I wonder how that impacts,
Well, and
in like just, demographics for those counties.
yeah, that would be interesting to look at. So we don't have, yeah, we could start to tease that out at some point. Population data has lagged. Census has been really slow releasing the data. So normally when shortly after they do the new census, they revise the last decade. And of course, the numbers came in for Vermont way higher than they thought they would be in 2020. It showed that, in fact, there was, substantial growth through the entire decade. And then in 2020 and 2021, there was very strong growth, like much, much higher. But 2022's initial estimate was practically flat, like almost just very little growth. Now, these things get revised, so I would kind of average those 3 years probably as a better indication. Yeah, the pandemic has skewed a whole lot of stuff that normally is, pretty stable, population being one of them. We tried to get at tax data, looking at first-time filers and trying to see who's working remotely and all that. And we got 39 million, almost $40 million in personal income tax revenue from first-time filers, both residents and non-residents in tax year 2021, which is double, what we've been, in 2020 was a big increase too. So we're not getting all of it because other states are pushing back on, if they're employers in our state, even if they're working in Vermont, they should owe tax in Vermont, but those states are pushing back on it. But still, we're getting a lot, and it doesn't seem to be dissipating. So it's still a question of how permanent that's going to be, but we've definitely benefited from remote work. And the longer it becomes sort of normalized and the better broadband gets, fingers crossed, that could be a game changer.
Madam Chair, thank you. I want to shift a little bit, but you hit on it, to the theory behind the ideal tax structure. And as we've been tutored, there are several elements to that, amongst which are reliability and things that are self-evident. But there's also what's called transparency, what's called competitiveness, not interfering with rational choice, et cetera, et cetera.
Efficiency.
And that it's accessible. Now, probably a generation ago in this committee, in this room, there was an ethic which tried not to vindicate those 6, but rather export taxes. Very much the way remote workers represent and institutions which are known to be good at shifting, like businesses.
Yeah.
Since that time, I'm talking the last 25 years, I think we've moved away as a state from that. And you could see that because business collections as a percentage of total collections have gone down for a generation anyway. And I'm just wondering, I struggle with the ideal, which is theoretically and ideologically driven, and the practical service to Vermonters, which is if you can find somebody else to help you out, don't hesitate.
I think all states do.
Yeah, and all states do this, certainly countries do.
Yeah.
And it's a struggle for me to buck here's the ideal and to push for an initiative which doesn't fit that. I also was somewhat reassured, a comment from Emily Byrne, that frankly, that paradigm, that 6 really is applicable to individual taxes. It's almost impossible to talk about those 6 in the context of taxing institutions like businesses. There's no meaning to accessibility or transparency when you're talking about the corporate income tax.
Yeah, but equity and efficiency.
I don't remember Emily saying that, so maybe when we dive deeper into corporate, we can explore that idea.
Well, equity and efficiency would be really important in corporate too, because especially efficiency, you don't want to do things that sort of mess up the market, that make it, and a corporate tax could.
And competitiveness, yeah.
Yeah. And then you do want equity in any tax. So in a corporate tax, that would be something too. We've actually ended up with a lot more. Corporate is now a bigger part of the whole tax base than it was through changes that we thought would be revenue neutral that weren't.
Yeah.
So the change of unitary tax was thought to be revenue neutral, but oftentimes when you do something like that, you're saying, well, the tax burden's going up, and you'll get some response, but there really wasn't anything in the way of a negative response that we got because we are such a small part
Of the pie.
of the total corporate pie for the entities that were subject to that. And you see that now too with with more recent market-based change. So we have a broader base, and they're more international and national corporations that are paying pretty substantial amounts, and they just come on in sort of fickle ways. Like all of a sudden there'll be like a big payment. You'll say, was that going to repeat, or is there something going? And you'll spend a lot of time trying to dig into that. And then you find out, okay, yeah, it's going to continue, but it was making up for something in the past too. And, but we have a lot more money coming from that whole area.
Thank you.
Yeah.
Well,
Okay.
thank you.
Thank you.
It was a pleasure.
Yeah, if there are more questions, we can take them later or
Yeah, well,
send me a note or something. Yeah.
yeah, thank you. And it's a great big picture way to start the year of our work. So thank you.
Yeah, I mean, you're constantly kind of having to go from like down on the ground to what do we actually do, but relate it to something bigger, and best policy does that. Yeah. Thanks. Yeah.
We have a break till 2:15.